At some point, you did the right thing. You opened a savings account. You started putting money in it, maybe automatically, maybe manually, but you did it. You were being responsible. You were doing what you're supposed to do. And somewhere in the back of your mind, you felt good about it. The balance was growing. You were saving. That's what financial security looks like, right? I remember feeling that way the first time I had a few $1,000s sitting in a savings account. It felt like progress. It felt like I was finally getting ahead, like the money was working for me. And then I learned something that genuinely bothered me. That money wasn't working for me. In a very real, very mathematical sense, it was actually losing ground. Quietly, every single month, without me doing anything wrong. That's what we're talking about today. Not in a scary way, but in a way that I wish someone had sat me down and explained clearly a long time ago. Because once you understand it, you can do something about it. Hey, welcome to the part they skip. The stuff they glossed over, the chapter that wasn't in the textbook, the money conversation on finance that you wish your teachers had with you. If you're new here, hit subscribe. We got a new video every week, and every episode comes with a free PDF. It's the cheat sheet of everything we covered today. Grab it in the description below. Now, before we get into it, I'm not a financial advisor, and this is not financial advice. Everything I share here is for educational purposes only. I'm going to give you a framework for how I think about this topic, but your situation is unique. Take what makes sense, leave what doesn't, and if you're making a major financial decision, always talk to a qualified professional first. All right, now let's get into it. Here's what everyone that is watching this wants to know. You want your money actually doing something while it sits there. You saved it, you were disciplined, you didn't spend it. The least it could do is grow just a little. And that's a completely reasonable expectation. The problem is that most people have no idea what their savings account is actually doing with their money, or more accurately, what it's not doing. And the difference between a savings account that works for you and one that quietly works against you comes down to one concept that most people were never taught. Here's the problem, and I want to lay it out simply because I feel like this is one of those things that sounds complicated, but really isn't once you see it. Inflation. That's the concept. And most people have a vague understanding of it. Prices go up over time, things cost more than they used to, but what most people don't connect is what inflation means for money that's just sitting there. Here's how I think about it. If inflation is running at 3% annually, meaning the general cost of goods and services is going up 3% every year, then $1 today buys less than $1 did last year. Not dramatically less, but measurably less. Now here's where your savings account comes in. The national average interest rate on a traditional savings account at a big bank has historically sat somewhere around 0.5% or even less. So, if your money is earning 0.5% in a savings account and inflation is running at 3%, your money is effectively losing ground at a rate of about 2.5% every single year. The number in your account goes up a tiny bit, but the purchasing power, which is what that money can actually buy, goes down. I remember the first time someone explained this to me and I genuinely felt a little frustrated. Not because I had done anything wrong, because nobody had told me that where you keep your money matters just as much as how much you save. I had been focused entirely on the saving and never thought about the keeping. And this is not a small thing over time. Here's how I think about the math. If you have a meaningful amount of money sitting in a traditional savings account for 10 years, earning next to nothing, while inflation chips away at its purchasing power, the gap between what you have and what you could have had is significant. Not catastrophic, but definitely real. The second part of this problem is opportunity costs. Every dollar sitting in a low yield savings account is a dollar not working harder somewhere else. A high yield savings account, a money market account, treasury bills, index funds for money you won't need for years. These are not exotic financial instruments. They're accessible to anyone with a regular bank account and 15 minutes. Now here's the framework that fixes this. Not all savings are created equal, and the first thing to understand is that different money has different jobs, and where you keep it should match the job that it has. Think of your money in 3 buckets. Bucket one is going to be your emergency fund and short-term savings. Money you might need within the next 1 to 2 years. This money needs to be accessible and stable. It should not be in the market where it can drop right when you need it, but it also should not be sitting in a traditional big bank savings account earning next to nothing. This money belongs in a high-yield savings account. These are FDIC insured, just like regular savings account. Your money is just as safe, but they pay significantly more interest. At various points in recent years, high-yield savings accounts have paid anywhere from 4 to 5% annually compared to the big bank average of under 1%. That difference on a meaningful emergency fund balance is real money. Bucket number 2, medium-term savings. Money you won't need for 2 to 5 years, a down payment you're saving towards, a future expense that you know is coming. This money can work a little harder. Treasury bills, I-bonds, or a conservative mix of investments depending on your timeline and comfort level. Bucket number 3, long-term savings. Money you won't touch for 5 years or more. Retirement accounts, investment accounts. This money should be fully in the market in a diversified portfolio. Because over long periods of time, the market has historically outpaced inflation significantly. So the simple move that most people can make today is just moving their savings from a traditional big bank account to a high-yield savings account. Same safety, same accessibility, just a better interest rate. It takes about 15 minutes to set up, and the difference compounds over time. I did this a few years ago, and I remember being annoyed that nobody had suggested it sooner. It wasn't complicated, it wasn't risky, it was just a better place to keep the same money. Here's the action framework. First, look up the current interest rate on your savings account right now. Log into your bank account and find it. If it's under 1%, you're leaving money on the table. Second, search for current high-yield savings account rates. Look at online banks. They consistently offer higher rates than traditional brick-and-mortar banks because they have lower overhead. Compare a few options. Look for FDIC-insured accounts with no minimum balance requirements and no monthly fees. Third, think about your money in the 3 buckets that we talked about. Emergency fund and short-term savings in a high-yield savings account. Medium-term savings in something slightly more productive depending on your timeline. Long-term savings in the market in a diversified portfolio. Fourth, make the move. Open the high-yield account. Transfer your savings. It takes 15 minutes and the compounding difference over time is worth every one of them. Your savings account should be working for you. If it's not, that's not a personal failure. Nobody told you to check, but now you know. Apply what makes sense for your situation. That's it for today. If this helped, hit like. It helps more people find the channel. Subscribe if you haven't already, and grab the free PDF cheat sheet in the description below. Everything we covered today, ready to save or share. This is video 6 of 10 in our foundation series, the 10 money basics every adult should know, but most people were never taught. If you missed the last one on net worth versus income and why your salary might be lying to you, that one is right here. Take a look. Otherwise, see you next week.